Everyone talks about financial analysis, but have you wondered why is it so important for running a business? Well, by analyzing a company's financial statements, you can gain valuable insights into its long-term financial health and make informed decisions about scalability in terms of profit and loss. However, for those who are new or unfamiliar with financial statement analysis, the task can seem daunting. If you're one of those many individuals, don't worry. In this video by Robert Schultz, we'll guide you through the process of analyzing financial statements, step by step. So, let's get started. Over the next 10 minutes, we're going to be diving into some pretty interesting topics that will help you analyze your financial statements better. First up, we'll be discussing the 5 key components of a financial statement, followed by the key considerations for an effective financial review, and lastly, what our project future scenario. Let's start with our first topic.
Before we begin, this video is powered by HighRadius, AI-driven autonomous finance solutions for the Office of the CFO to transform your order-to-cash, treasury, and record-to-report functions.
Give it a try.
This tutorial is going to cover credit and financial statement analysis, and specifically what to look for in a financial statement. We have several learning objectives. First, we're going to have a brief review of the important components of a financial review. But just a brief review, components of a financial statement are the balance sheet, the profit and loss statement, cash flow statement. Then you want to understand key ratios that'll give you a really good view into the company's performance and the trends of the company's performance. You look at all this in the context of benchmarking with similar companies in their industry, and it puts it all into a context that makes it very effective in understanding financial results. So why even do we review financial statements? Well, it gives you an insight into past trends, the strengths and weaknesses of the company and their past performance. You can use these trends to really project in the future the likelihood that a company is going to be able to meet its obligations. There are certain things that you should consider in the real world context here. Financials are a historical document. They don't necessarily predict future performance. They just kind of indicate the direction that the company is going. But there's a lot of things that are not reported in the financials that may have happened since the financials were produced, such as recent changes in management could really affect the viability of the company, the direction, and the revenues. They could have lost several major customers that have affected their revenue and their profitability. The competitive environment could have changed. Another company could have come into the market with a superior product, really taken away a lot of market share and revenue potential for the company in the future. You're not going to see that on the financial statement. There could have been a natural or man-made disaster that's affecting their revenues. Just think about the COVID-19 virus. Then we're going to talk about key considerations that you should think about when you're doing a financial review. So there's some considerations that you should really think about when you're analyzing a financial statement, where you're looking at it and try to understand, what is it really telling you? When you're looking at increases in cash, for example, what are the sources of that cash? Did it come from actual sales and profit? Or did it come from a deposit after they borrowed the money? Was it from the sale of stock? So these things you can see really different, and you should understand, where did that cash actually come from? Are there liquidity differences that you should be concerned about as to whether they're going to be able to generate enough cash in the future to pay their obligations in the long term? Do they have commitments to significant capital expenditures? If they do, what is the purpose for those capital expenditures? Is it something that's going to enhance the productivity of the company, the ability to generate revenue and profit? And how did they fund that? You need to understand, how did they fund that? Understand their available financing. Are there changes in that financing and the mix of the financing or the cost of the financing that would be of concern. Look closely at their debt to equity over time. Is it going up? Is it going down? Is there a concern raised by an increase in debt to equity? Are there unusual or infrequent transactions that are not in the normal course of business that are reported that affect the income results? Was it a large purchase? Do they have some differences in the reserves that you need to understand a little bit better? What is the source of material changes in the relationship between their costs and their revenues? What causes the cost to go up in relation to revenue, or the cost to go down significantly in relation to the revenue? Was there a change in the price of labor or inventory or materials, or were there just some sort of an adjustment that they made that's a book adjustment and it really wasn't driven by the operation of the company at all? What are the sources of increased sales? Was it price increases that just made sales look larger, or did they actually sell more product or service? Even an audited statement doesn't guarantee that it's completely accurate. So you need to ask questions whether financial statements are audited or unaudited. If it's unaudited and it seems way too good to be true, you should understand if there's off-balance sheet financing, for example, pensions, some impending doom. You need to understand if there's something not reported on the balance sheet that is of a concern. Is there funny business and adjustments to their reserves? You really want to look at that. What about discretionary expenditures? Did they spend money? It was a quick hit at the expense of long-term growth and profit. What about foreign financial statements? You need to understand the differences from U.S. financial statements. Look at trends, preferably 2, preferably 3 consecutive periods. Is performance going up? Is it performance going down? Is it improving or deteriorating? One thing you can do is what-if scenarios. So you create a base case based on past trends. You can project future performance. And then you kind of throw in there things that you know that might affect performance going forward due to competitive issues or economic trends or whatever it is. And you set a base case. This is how I expect the company to perform in the future. Now, if revenues were to drop significantly, for example, or expenses were to go up significantly due to supply chain issues or whatever, and you project a lower revenue or profit, but it doesn't kill the company, it just stresses it, they can still meet their obligations, that's a stress case. So you can kind of say, well, if revenue went down by 10%, what does that do to the viability of the company? Are they still going to be able to pay their obligations? And then you can set a default case. Well, if it went down 20% based on extending the base case, going down by 20% in revenues or profit, then the company will not be able to meet its obligations. By doing this, you put some realism to it. You can say, okay, if it's within this band of deterioration, they'll still be able to make it. If it goes beyond that, this company doesn't have the flexibility to continue to meet their obligations. And you can do a risk assessment based on things you see in the future, from competitive issues, economic trends, etc. And it kind of gives you an idea of what will happen if certain events occur. So what did we cover? We covered the importance of analyzing financial statements to help determine the company's creditworthiness. And we talked about key considerations that you should use for an effective financial review.
This video is part of the Highako Academy's Financial Statement Analysis Skills Certification Program. This online certification program is designed to offer credit professionals an in-depth understanding of the different tools and approaches for interpreting financial ratios and financial statements to determine your customer's creditworthiness. Earn a digital skill badge and certificate once you complete the certification. Check out the link in the description for more information about the skill certification. If you liked what you learned in this video and want to learn more, subscribe to our channel and leave a thumbs up. Which other credit, collections, or treasury topics would you like us to cover next? Tell us in the comments section below. See you in our next video.